Hey, it's Finance Flicks Hub here. And today, we've got something big. Like, $152 billion kind of big. Albert just finished reading the new defense budget bill, and it's got some eye-popping numbers, particularly for defense spending. We're talking billions headed straight into the pockets of major defense contractors. If you're someone who's trying to understand where the smart money is going in this chaotic global environment, you'll want to pay attention. Now, Goldman Sachs, yes, that Goldman, has highlighted 4 stocks they think will benefit the most from this massive wave of defense spending. They've got data, they've got timing, and they've got the track record. We've dug into their research, added our own technical and strategic analysis, and in this video, we're going to break down each stock in detail. We're talking real research, real opportunities, and practical steps, not hype or get-rich-quick garbage. Let's jump right in with the list. The 4 defense stocks Goldman Sachs is spotlighting are 1. Huntington Ingalls Industries, ticker, HI. 2. Lee Harris Technologies, ticker, LHX. 3. KTOS Defense and Security Solutions, ticker, TOS. 4. AeroVironment, ticker, AVAV. You can write those down, but just knowing the names won't do much if you don't understand why these stocks are in play. So let's break them down one by one, starting with the biggest shipbuilder in America. 1. Huntington Ingalls Industries, HII. Huntington Ingalls Industries is the only major shipbuilder in the United States that constructs nuclear-powered aircraft carriers. That's their bread and butter. If the US Navy needs a new carrier or destroyer, there's a good chance it's HI doing the heavy lifting. Here's the thing, the 2025 defense budget is funneling nearly $29 billion into shipbuilding. That's on top of an earlier $1.3 billion award aimed at workforce development and infrastructure improvements. So Huntington Ingalls isn't just building ships, they're upgrading their ability to build more ships, faster and more efficiently. That's a long-term competitive advantage that Wall Street notices. Now, let's talk technicals. We first spotted HI back in April, just as it was breaking out above its 150-day moving average. That's a key level that institutional investors pay close attention to. After the breakout, the stock started to consolidate, zigzagging sideways instead of continuing straight up. And that's not a bad thing. Sideways consolidation often means buyers and sellers are in a standoff, waiting for a catalyst. In this case, the defense bill could be the fuel that sends it higher. If you had entered around that April breakout, you'd be sitting on around an 11% gain. Not life-changing, but a solid return, especially considering the defense spending hasn't even kicked in fully yet. There was also another buyable dip at around $240. That setup repeated the same pattern, breakout, consolidation, push. Of course, not every day is a green candle. The stock did pull back by about 2.2% on a Tuesday. But that's not a collapse, that's normal market behavior. Stocks never move up in a straight line. Pullbacks are healthy. They give you what we call second chance entries. How do you handle pullbacks without getting caught in a falling knife? With stop losses. That's how serious investors protect themselves. You don't need to predict the future, you just need to limit your downside. And here's something important, HI isn't just riding a wave of hype. It's backed by government contracts, long-term defense strategy, and critical infrastructure investments. It's a real business solving real needs, and now it's being fueled by federal money. 2. Lee Harris Technologies, LHX. Next on the list is Lee Harris, a company at the heart of next-gen warfare. If you've ever read about hypersonic missiles, space defense systems, or cyber warfare platforms, there's a good chance Lee Harris is involved. In the new defense budget, there's over $24.4 billion going into hypersonic missile development, next-gen defense systems, and space-based deterrence. That includes everything from layered homeland defense systems to highly specialized satellite communications. Lee Harris is well positioned to benefit from all of that. A major piece of this puzzle is their Aerojet rocket dyne unit. These folks are experts in missile propulsion. When you hear about a missile traveling at 5 times the speed of sound, it's probably got parts from Aerojet inside. From a technical analysis standpoint, LHX caught our eye in early May. The stock formed a classic cup and handle breakout pattern. After completing the handle, it surged past previous highs, and we saw a big spike in trading volume. That volume spike is crucial. It tells you this isn't just retail traders piling in, it's likely institutions taking major positions. If you got in around the breakout point, you'd be up roughly 13%. Now, that doesn't mean the move is over. We're seeing another familiar setup, a stair-step pattern with a pullback. If LHX clears the recent highs again with volume, it could be primed for another leg up. This is the kind of setup that smart traders wait weeks or months for. It's not about jumping in blindly, it's about being strategic. 3. Kratos Defense and Security Solutions, KTOS. Third name on Goldman's list is Kratos Defense, a smaller cap company with a big role in the future of modern warfare. Kratos focuses on affordable, scalable defense technology. That includes drones, UAVs, jet engines, and a mysterious but very real segment called C5IS, which covers command, control, communications, computers, combat systems, intelligence, surveillance, and reconnaissance. In short, Kratos builds cheap, effective, fast-to-produce tools for modern military missions. Why does that matter? Because the new defense budget allocates $16 billion specifically for scaling low-cost weapons systems. These systems are meant to counter threats without needing a $100 million fighter jet. We first flagged Kratos in early May. At that time, the stock was approaching key resistance levels, but hadn't yet broken through. It did eventually break out on May 27th. Since then, Kratos is up around 20%, and again, it's showing a familiar chart pattern: breakout, pullback, new base. You don't want to chase after these names just because they've already gone up. But if the stock pushes above its recent highs with strong buying volume, that could signal another move higher. Kratos is a classic example of a high-risk, high-reward name, but it's got real government tailwinds behind it. You've got to be smart here. Set stops. Protect your capital. But the opportunity is there. 4. AeroVironment, AVAV. Last up, we've got AeroVironment, known for its Switchblade drones, small, lethal, and often used in tactical battlefield situations. These aren't hobby drones. They're designed to fly into enemy territory and take out specific targets. This type of unmanned aerial system, UAS, is a major focus of future warfare strategy. The defense bill sets aside about $1.4 billion for developing the UAS industrial base, and AVAV is one of the key players in that space. This stock recently made a huge move, from $191 to $294 in a flash. That's a massive gap up. And what often follows a big move like that? A pullback. AVAV has since dropped and is now stabilizing. And here's the interesting part: the volume is dropping as the stock pulls back. That's a bullish signal. Fewer sellers usually mean we're getting close to a bottom. We're not buying yet, but we're watching closely. What we want to see is a bounce back with rising green volume, a sign that the buyers are stepping back in. That would be the second chance entry. Remember, chasing isn't a strategy. Waiting for confirmation is. Common mistakes to avoid. Let's talk for a moment about what trips most people up. Cheap is relative. A $5 stock can drop to $1. Don't buy based on price, buy based on value and technical strength. If you're jumping in because a stock is already up 20%, you're late. Look for the next setup. Not every ship sails right away. If you can't explain your strategy to someone else, you probably don't have one. And if you don't have a plan, you'll make emotional decisions. If a stock broke your stop loss and dropped 30%, hoping it'll come back isn't a plan. That's a recipe for pain. Why this matters now? This isn't a video about hype stocks or chasing the latest headlines. This is about understanding how federal dollars flow and how you can position yourself in front of it. When the government commits $152 billion to defense, that's not a one-time stimulus. That's multi-year, contract-based, infrastructure-backed investment in specific sectors and companies. The 4 stocks we've talked about today: HI, LHX, KTOS, and AVAV, are aligned with different priorities in that bill. 1. High benefits from shipbuilding and workforce development. 2. LHX is tied to next-gen missile systems and satellite propulsion. 3. KTOS is all about affordable, scalable drones and combat systems. 4. AVAV is a key player in battlefield autonomy and smart drones. Understanding this alignment gives you an edge. It helps you filter the noise, pick your spots, and move with confidence, not emotion. Thanks for watching. Make sure you subscribe our channel.